Hello, this is your daily dose of financial market trends. CoreWeave just posted a quarter that's turning heads across Wall Street, while diplomatic tensions over Ukraine's energy strategy could reshape oil markets. Let's break down what's moving money this morning. Before we dive in, here's where we stand heading into today's session. Yesterday's close had the S&P 500 at 7,728, down about 1/3%. The Nasdaq ended Tuesday at 26,445, losing 0.6. The Dow finished at 53,792, also down 1/3. Meanwhile, the VIX ticked up slightly to 15.37, and the 10-year Treasury yield pulled back to 4.68%. Let's start with CoreWeave, the AI cloud infrastructure play that's suddenly everywhere. The company just reported revenue of $2.5 billion for the quarter, up massively as enterprise demand for AI compute keeps accelerating. What makes this particularly interesting is how decisively they've pivoted away from crypto mining roots toward pure AI infrastructure, and the market's rewarding that focus with a 16% surge. This isn't just about one company having a good quarter. It's a signal that the AI infrastructure build-out is real, not hype, and there's serious money flowing into the picks and shovels layer of this technology shift. Next up, Irene is riding that same AI infrastructure wave. The company's expanding battery storage capacity while positioning itself squarely in the AI data center space, and it's catching attention across geopolitical analysis, earnings watchers, and momentum traders all at once. The connection to CoreWeave's blowout results isn't coincidental. When one player in the AI infrastructure ecosystem posts numbers like that, investors start hunting for the next beneficiary. Irene's getting that second look right now. Now to JD.com, which is having a rougher time. Shares dropped more than 4.5% yesterday on unusually heavy volume, and the company reports earnings tomorrow, which always amps up volatility. But there's a weird twist here. J.D. Vance, the vice president, made comments about Ukraine halting strikes on tankers using Russian ports, and somehow that got tangled up in headlines with JD.com's ticker. It's a reminder that in today's algorithm-driven news environment, sometimes ticker symbols catch crossfire from completely unrelated geopolitical stories. The real story is earnings risk heading into tomorrow's report, but the noise around the name is definitely elevated. Finally, both SPY and QQQ are showing up on radars today, not because of dramatic moves, they're both down modestly, but because of unusually intense social chatter. When the broad market ETFs start dominating conversation threads, it usually means retail investors are trying to read the macro tea leaves rather than picking individual names. That defensive positioning often shows up right before people expect volatility or a directional move. On the geopolitical front, 3 scenarios are worth watching closely. First, U.S. diplomatic pressure on Ukraine regarding energy infrastructure strikes. Senior American officials are asking Ukraine to stop attacking oil tanker operations at Russian ports, which could signal shifting boundaries on Western support. The bull case, with about 35% odds, is that Ukraine agrees in exchange for other security guarantees, which calms oil markets and drops the risk premium on Brent crude by 3 to 5%. That would hurt energy sector margins, but lift broader equities on lower inflation fears. The bear case, running about 40%, is Ukraine doubles down instead, spiking oil prices 8 to 12% and benefiting energy stocks while punishing rate-sensitive growth names. Second scenario, China's dominance in global oil markets. China now controls enough strategic reserves, refining capacity, and import flows that it's effectively setting global price dynamics. The bull case at 25% probability is that China uses this position cooperatively, coordinating with international partners to reduce volatility and support global growth. Equity markets could gain 2 to 4% on that stability. The bear case at 30% is China weaponizes oil markets for geopolitical leverage, creating wild 15 to 20% price swings that crush energy-intensive industrials and favor defensive sectors. Third, the Federal Reserve's policy stance amid economic divergence. We've got FOMC statements alongside Fed officials acknowledging that lower-income Americans are really struggling, revealing a split economy. Bull case at 40%. The Fed prioritizes employment concerns and accelerates rate cuts, dropping Treasury yields and lifting growth stocks 5 to 8%. Bear case at 35%. The Fed stays restrictive despite hardship, pushing 10-year yields toward 4.8% and hammering high multiple tech stocks. Quick housing update. 30-year mortgage rates sit at 6.69%, while inventory has climbed to 9.3 months of supply, well above a balanced market. With building permits declining and price growth slowing to just 1% year over year, we're seeing real cooling. If the Fed cuts rates soon, that inventory could clear quickly. But if rates stay elevated, builders face serious margin pressure ahead. On the earnings front, JD.com reports tomorrow, and given yesterday's volatility and volume spike, that report is going to set the tone for Chinese e-commerce sentiment heading into the fall. So what does all this mean for your portfolio? 5 things to keep on your radar. 1. AI infrastructure spending is proving durable. CoreWeave's results validate that the build-out is real. So companies exposed to data center expansion and compute demand deserve attention. 2. Geopolitical headlines are creating weird ticker noise. Make sure you're reacting to actual company fundamentals, not algorithmic headline confusion, especially around earnings. 3. Oil market dynamics are shifting fast. Whether you're in energy names or rate-sensitive growth, understand that both Ukraine diplomacy and China's market power could move prices dramatically in either direction. 4. The Fed's juggling conflicting signals on the economy. Watch whether policy tilts towards supporting employment or fighting inflation, because that choice will determine which sectors lead. And 5. Housing market dynamics are at an inflection point. Inventory's building, rates are elevated, and the next Fed move could either unlock a transaction wave or squeeze builder margins hard. As always, this is educational content, not financial advice. Do your own research and trade accordingly. That's your Morning Market Digest for Wednesday, August 12th. We'll be back tomorrow morning with whatever the market throws at us next. Trade safe out there.